Good afternoon, everyone. Welcome back. Well, my topic is just pretty simple. How Malaysia survived when US meet China. To be honest, I'm quite sleepy now because yesterday night I couldn't sleep well. I just keep on looking at my social media, X, Weibo, Twitter, whatsoever it called. Because I'm afraid that maybe Trump at the US side, he just wake up and say, I'm going to tax Malaysia for 10 more percent. You got no idea how Trump is going to decide how many percent, by how, to tax on some particular country. So Malaysia, like it or not, we are relatively small compared to the giants. So as an investors, definitely the next question is, how are we going to leverage? How are we going to exploit on the opportunity when US meet China? Well, I'm pretty sure that this chart, all of you have already seen it. And to be honest, my session was quite sad because just now my colleague, he just presented one of the best performing market. And now I'm going to present one of the worst performing market. Well, as you can see from the slide, as you can see from the table, most of the time, I have listed out 4 events. It's represented what happens to KLCI. And one interesting part about these 4 events, 3 of it is a global event. 1 of it is an application of all these events. Because the world, they got no idea what Trump is going to do. They got no idea what Xi Jinping is going to do. So, what are the actions? They just take a step back from emerging region, with Malaysia in one of it. That's why we have seen the persistent foreign outflow since, I think, last year, somewhere around August, when the Bank of Japan is starting to spook the market with interest rate hike. And ultimately, coming to today, we have finally seen some sign of foreign net inflow is coming back. This chart is going to conclude what's our thoughts on the Malaysian market. Where on the external side, on the macro environment, we can see that Malaysia, as per the latest information, we are being charged by 25% tariff rate. Do you think that is a bad news? On an economic basis, yes. No matter how low or how high the tariff are, it is impacting, negatively impacting our exports. But what interesting about this table? We are at 25%, so do Korea, so do Japan. We, Malaysia, we are having a same tariff rate with so-called US allies, South Korea and Japan. Meanwhile, our ASEAN counterparts, Thailand, 36%. Indonesia, as per the latest one, 19%. Vietnam, 20%. So let's take an example. Take a look at Vietnam and Indonesia. Although, yeah, currently they are having a relatively lesser tariff compared to us. But what have they sacrificed? They just accept US goods with 0 tariff. So can you imagine that if you are sacrificing such an advantage, meaning that you are welcoming all the US investors, all the US goods to flood into the market? In the short term, yes, it seems like a positive news. But what if it's from the longer term? Can you imagine that Malaysia one day, if suddenly Anwar say, hey, we're going to welcome you, all US goods, all China goods, just flush into our market with 0% tariff. Immediately, all these giants, they will straight away come to our market because they are very cost effective. They got much more cash power compared to the SME of Malaysia. In the short term, as a consumer, we feel like, oh, sure, Luckin Coffee is coming in, all these MNCs are coming in, quite sure. In the short term, yes, because they will have a price war. But in the longer term, when all these SMEs, they are struggle because they cannot compete with all the large MNCs, they're going to be bankrupt. They're going to go bust. And what's next? It's going to hamper our global GDP, our Malaysia GDP. And in the longer term, it's going to be detrimental to our economy. So overall, what I've explained the longer term is just pretty much can conclude with, now we are having 25%, but it is not all doom and gloom for Malaysia. Yet, we are waiting for the catalyst. We are waiting for Trump to decide what's the final rate for Malaysia. That's why you can see that from the investors' takeaway, the outcome for the second half remains vague. We believe that the KLCI for the second half, at least for our base case scenario, will maintain to be quite lackluster. But if, should, the tariff outcome has been more clear, has become clearer, that will be translated into a tailwind for Malaysia. Next thing, speaking of AI, I believe that a lot of people, investors, AI is a buzzword. Malaysia, we do have AI as well, but our AI is more like ayah. Because we are losing in terms of the technological advancement. Like US, like China, they are far beyond us. But what's our advantage? Our advantage, we have, although it's still a sad truth, but we have a cheap labor. What's our advantage? We have a geographical advantage, meaning that we don't see all these, volcano eruptions, all these natural disaster. We are quite safe. So that's why we are very appealing region for the MNCs. They want to come to our country. They want to build a manufacturing plant because in the longer term, the chances of a natural disaster in our country is very low. So back to the domestic part. For the second half, we remain cautious, like what I mentioned just now. Our 2025 GDP growth forecast currently, as per the latest figure, is about 4.5% quarter two. But overall, we think that conservative range as 3.5 to 4.5%. Overall, as per the latest Q2 GDP, we can see that the companies, they are taking a more front-loading activities. But we believe that the front-loading activities, it will halt at starting from third quarter. On the fiscal consolidation and infrastructure part, well, although it's a little bit late to say that, but overall, if I want to conclude my presentation, you just need to know three things. All right? First thing, equities. Second, fixed income. And third, ringgit. For equities, what we need to look at, first thing is definitely the external environment. But what can we do? Nothing. We just wait. So what can we do when we look from the domestic side? From an investor perspective, what I like about Malaysia is this logo, Economy Madani. Well, our current government, they are quite straightforward. They already told us, in fact, last year, they are having the fiscal disciplinary activity. This is a nice word. In another word, I want to tax you higher. I want to take back your subsidy because of fiscal disciplinary. This is kind of like a negative news for our stock market. But they do have a positive news for our stock market as well. They already explicitly mentioned that we want to revive the infrastructure projects. As you can see, the MRT3, RRT, Penang RRT, airport projects, even some of the East Malaysia projects, all these infrastructure programs are ongoing. On the other hand, what are we waiting for the next catalyst? Don't forget that HSR is still on the pause. When are they going to announce? No idea. But we believe that in the longer term, maybe for the next 2 to 3 years, HSR is going to be the game changer should they announce it and they manage to continue the projects. So overall, for equities, as you can see from this chart, in fact, this is one of my favorite charts to show investors. For Malaysia equities, the KLCI, we have three big components, three major components. First one, foreign investors. These foreign investors are the large players. They are the dominant players that any inflow or outflow can easily influence our Malaysian market. The next one, local institutions. They are dominant as well. Who are they? They are like Co-op, they are like EPF, they are like PNB, they are like some of the fund houses. They are the local institutions. Third major components, local retail. Who are they? Me and you and everyone in Pavilion Mall. So you can see that starting from last July, where KLCI is starting to experience a sharp drawdown, who are the net outflows? Foreign players. Do you recall that just now I mentioned that foreigners, they are taking a more wait-and-see approach? So now, when is the next catalyst? We believe that should any clarification on tariff negotiation, on the external side, we are having any tailwinds, it could translate into a catalyst for KLCI. So overall, for equities, if I want to conclude this slide with just one sentence, I would say that the theme for KLCI for the second half is wait and see. So it somehow translates to our investors take away these few sectors because they are fundamentally providing a quite appealing dividend stream, quite appealing income stream, and overall the balance sheet is quite solid. So let's take some example like banks, utilities, consumer staples. They are giving you about ranging from 4% to somewhere around 7% kind of dividend yield. So for the second half, if Malaysia maintain, meaning that nothing has happened, you are enjoying this sort of 4 to 7% of a dividend income stream. If there is anything happen, let's say the external environment become clearer, let's say domestic players, they're starting to support the economy, it should translate into a catalyst for the market. So this is why, despite Malaysian market has been kind of lackluster, but we still encourage investors to hold your position in Malaysia because when the tide turns, that's the time when you to gain profits. And overall, our KLCI targets for the second half will be 1,600, while our longer term, 2027, will be 1,800. The next one, regarding the fixed income. Well, for the latest news, Bank Negara Malaysia, they just reduced their interest rate to 2.7%. And it is the first cut in the 5 years. Overall, the Bank Negara Malaysia, they have quoted some of the moderation on our economy. They are taking a more cautious approach. But overall, we think that this insurance cut this cut is considered as an insurance cut. Well, when you are witnessing a rate cut, you need to know two things. Whether this rate cut is caused by insurance cut, meaning that the Bank Negara Malaysia, they are seeing some of the weakness in the economy, so they are taking an insurance cut. Or because there is a major event happening in the economy, meaning that I'm using a simpler word, the economy quite jialat already. In this case, then they reduce rate because they want to support the economy. Then it is not a good signal. So overall, you can see that Pavilion, Bukit Jalil, even my office just beside Pavilion KL, we can see that retail consuming power, retail consumers, they are quite solid. Although no doubt, in terms of economy, we are witnessing sort of like moderation, but overall, it is still considered as healthy. So that's why Bank Negara Malaysia, they reduced the interest rate is because of insurance cut. And overall, our base case, there will be no rate cut for the second half, but we do not rule out a probability of one more rate cut, and it will be then insurance cut. Okay, that's all from the technical part. Let's go to the easier part. What is the impact of rate cut to our economy? When Bank Negara Malaysia, they reduce the interest rate, in a simpler term, your loan becomes cheaper. You can get a mortgage rate at a lower level. Your credit card payment become, your credit card interest rate become lower. So when this kind of scenario happens, what are you going to do? You can buy more, you can spend more into the economy, and eventually it creates a positive spiral to the economy. So this is why when Bank Negara Malaysia, they reduce the interest rate, actually, it is a positive signal to the economy. For the fixed income investors, this is a slide that you need to take note. For money market fund, one of the common questions that we face, a lot of investors ask me, why should I invest? Why should I put my money in stock market? No point. Fixed deposit rate is giving a 4%, let's say promo rate. Now, the fixed deposit rate, after a rate cut, we are guessing probably ranging from 3% to 3.5% for the FD rate. But don't forget that FD rate is following your interest rate. So even if you manage to secure 4% for this year, what's happened next year, the year after that? You need to embrace the new rate. So this is why we encourage people to look at bond. Although I'm an equity guy, but bond, you need to view it as an income diversifier. It's an income stabilizer for a portfolio. If you, let's say you want to buy, let's say Malaysia government bond, 30-year, meaning that you are locked in your rate at somewhere around, I think, about 3.9% to 4.1%, meaning that you are locking this kind of rate for the next 30 years. It will serve as an income stabilizer. And overall, just a quick one, for money market funds, you are trying to gain liquidity. So with such an interest rate, definitely is not that appealing, but we still encourage people to look at money market fund because you need cash in your holdings, right? To the second part, longer duration bond or bond funds. Currently, like what I said, our base case is no rate cut, but should there is any rate cut, it will serve as a potential price appreciation for your investment. And even if there is no rate cut, you manage to secure your rate at current level. Okay, so this slide will be quite important for investors or if you are travelers. Overall, we think that US dollar against Malaysian ringgit will be hovering about 4.2 to 4.3 by year end of 2025. How to understand this chart? Basically, you can see that there are two colors, green colors and red colors. Because in the reality, one thing doesn't mean that the second thing happened. We don't have such a formula. So this world is surrounded by multi-factors. Interestingly, for ringgit, we think that these 6 factors, they could impact the ringgit. And overall, for the top 3, it could translate into a tailwind for ringgit and make ringgit to appreciate. But on the other hand, the bottom 3 factors, they will make the ringgit to depreciate. I just go it very quickly, where you can see that although the government they has mentioned that they want to have fiscal disciplinary activity and is be negative, temporary negative to the economy. But think from another view, because the government they managed to collect tax, they managed to secure their payment. So it's a good thing for our Malaysia credibility. So it will make ringgit to appreciate. Let's say for foreign outflow, because of foreign outflow, they will need to sell ringgit. And when they sell the ringgit, it will flood the ringgit market with a high supply. So it will make ringgit downwardly depreciate. Because for the time interest, I don't think I managed to go through all this. So I will encourage you take a photo of this. And we do have an article on our website. Should you have any question, feel free to ask your client investment specialist on our website, or you can take a look at the Malaysian ringgit article. Okay, so overall, what's the impact of ringgit to your investment? For unit trust investors, let's say if you are unit trust investors in Malaysia, you're a buyer of Malaysia unit trust, no impact because you are using ringgit. But what if you are purchasing a Japan unit trust, you are purchasing a global unit trust? At this juncture, we think that take a MYR H class is a better option because it mitigate your currency risk. For the bond investors, maybe you can take a look at our long-term bond because you need to know that bond investors, let's say if you invest in a global bond, AUD bond, USD bond, you are also facing a currency risk. So if you want to lock in your yield at a longer term, maybe for the second half, it's better for you to take a more cautious approach where the ringgit-denominated bond is serve as a buffer for you. Last but not least, if you got really no idea, I don't want to care about ringgit, I don't want to care about anything, just buy our managed portfolio. Because we do have a dedicated team to arrange, to select the investment tools that they think it worth the best fit for your portfolio. This is going to be my last slide, where if you are just come back from lunch, if you just want to fall asleep, it's okay. Because as long as you manage to read this slide, basically you have already finished my entire presentation. For stock investors, we think that because of the vague situation on the second half, banks, utilities, consumer staples, or even REITs serve as a good place in a portfolio. For unit trusts, especially for a global unit trust, go for MRH class. And if you want to invest in Malaysia, but you got no idea what to invest in the stock market, just now you still remember ETF versus unit trust. And I am here to say that Malaysia unit trust, Malaysia fund manager, they still manage to deliver alpha because Malaysia, in reality, we are less efficient compared to other markets. Move to the fixed income side. Money market fund, although in fact the yield is getting lower and lower, but you still need to put some money on that because it serves as your cash portion. It gives you liquidity. In IFAS, in FSMONE Malaysia, we do provide a system called auto sweep. Means that as long as you put your money inside, we automatically will arrange it into the money market fund and give you a yield very close to the current interest rate environment. For long-term bond investors, Malaysia ringgit-denominated bond is still a viable option to serve a buffer for your currency fluctuation. I think that's pretty much for my presentation, and thank you everyone.